Hello class, I welcome you all to this session. This session we are going to discuss one more problem under fluctuating capital method. So before going through this problem, I will take you through one important theory part that you need to understand. Pause the video. I will anyways upload the notes also, but just listen carefully whatever is being told. When appropriations are more than available profits. When profits are less but the amount to be appropriated among the partners is more, what to do? I will just read through this example. A and B are partners. As per the deed, the partners are to get a salary of 1 lakh and 1,20,000 per annum. So 1 lakh and 1,20,000 is a salary of A and of B. And interest on capital at 10% per annum, which is 20,000 and 40,000 respectively. Net profit for the year is rupees 1,10,000 will be appropriated in the ratio of 3:4. You have to check. Okay. So, but the profit sharing ratio is different, 2:4. Now, you can see I have made one tableau column here. This is just one small table. A, B is here. Salary, how much he has to get? 1 lakh. B, 1,20,000. Interest on capital given. A has to give 20,000. B has to get 40,000. So, individually they have to get as 1,20,000 and 1,60,000. But together if we add these two, total appropriations is how much? 1,20,000 plus 1,60,000, which comes to 2,80,000. Total available profits is how much? 2,10,000. Now there is a shortage of 70,000 rupees. So this is what this case in the madri situation in the what you have to do when appropriations are more than available profits. Appropriation is how much? 2,80,000, which is more than the available profits. How much? 2,10,000. So what is the accounting treatment? Please carefully observe this. Accounting treatment: when total appropriations is more than the profits available, then profits to be distributed in appropriation ratio, not in the profit sharing ratio. So whatever is the appropriation ratio, in that ratio only you need to apportion this 2,10,000. So what is my appropriation ratio? 12:16 or 3:4. So this ratio only I have to apportion the profits. So after knowing this information, I want you to go through this particular problem. So on 1st April 2013, Jay and Vijay entered into partnership for supplying laboratory equipment to government school situated in remote and backward area. So they are into supplying remote laboratory equipment for remote schools. They contributed capital of rupees 80,000 and 50,000. So what is the capital contribution? 80,000 Jay contributed and 50,000 Vijay contributed. And agreed to share profits in the ratio of 3:2. So they have given the profit sharing ratio. The partnership deed provided that interest on capital shall be allowed at 9% per annum. So interest on capital will be allowed at 9% per annum. So how much is the capital of J? Vijay? J's capital is 80,000. Vijay's capital is 50,000. So interest on capital is 9% per annum. So if we calculate 9% on 80,000, I am getting 7,200. And if I calculate 50,000 into 9%, I am getting 4,500. So total interest on capital is how much? Totally it is which is 11,700. Am I right? So 11,700 is the total interest on capital. Now I'll continue reading the problem. During the year, the firm earned a profit of 7,800 only. So how much is to be appropriated? total amount for appropriation is how much? 11,700. Total available profits is how much? 7,800. So total available profits is less than the appropriation amount. So what ratio you need to follow? In the appropriation ratio, the profits need to be distributed. Okay, so in the appropriation ratio, what is the appropriation ratio? 72:45. Am I right? Or 8:5. Okay, so 9 table if we do 8:5. Now this ratio la what you have to segregate? The profit. 7,800 needs to be segregated among the partner. So what is the some asking, they are asking, showing your calculations clearly, prepare P&L appropriation account of J and Vijay for the year ended 31/3/2014. So this is what so individually each partner how much he has to get, we will calculate for J and for Vijay. For J it is 7,800 into 8 divided by 13. 7,800 into 5 divided by 13. Okay, so this is what we have to do. So I have calculated this. If I calculate, J has to get an interest on capital, that is the profits to be segregated, interest on capital as 4,800, and Vijay has to get 3,000. As per what ratio? As per the appropriation ratio, the profits is being segregated. I'm sorry, not interest on capital, the profit is segregated. Okay, now we are going to prepare the P&L appropriation account. So while preparing the P&L appropriation account, we need to be very careful. We need to write by P&L account net profit. How much is the net profit? 7,800 is the net profit. Okay, so 7,800 is the net profit. To what you have to write? To J's capital account, that is the interest on capital. How much? 4,800. To Vijay's capital account, that is also interest on capital, that is 3,000. So we are done with this. So 7,800. See, you cannot apportion. You may have a doubt that ma'am, interest on capital we have to calculate 80,000 into 9% per annum. Similarly for Vijay, this is for J. Similarly for Vijay, it has to be given as 50,000 into 9%. Ma'am, totally we have to pay him 11,700. But since 11,000 it is the interest on capital, you should be very clear. Interest on capital is an appropriation of profit. It is not a charge against the profit. Charge against the profit na enna பண்ணுவோம், நம்ம இத மொத்தமா காமிச்சிட்டு we will show it as an expense, that is a loss ஆ காமிச்சிருவோம். இப்போ 11,700 7,800 இருக்கு. So we will set off. Suppose if it is a charge, I am showing 11,700. We will show a profit, whatever is there. We will show that profit, and finally we will show the loss as 7,800 minus panna 3,900 is the loss அப்படின்னு சொல்லி we will show. But in this case it is not like this, because it is an appropriation of profit. Whatever is the profit, adilirundhu you need to segregate this. In what ratio? In the appropriation ratio. Okay, so I'm sure that you're clear with this. And one more small theory part that we need to discuss. I'll just discuss that now. If at all salary or commission, that is a remuneration to be paid to partners, salary or commission is an appropriation of profits and not a charge against the profit. Like interest on capital, it is an appropriation of profits and not a charge against the profit. Therefore, salary and commission is allowed only if the partnership deed allows it. So this is very important. No, if partnership deed is silent, there is no provision in the partnership deed, there will not be interest on capital, there will not be any salary given or remuneration or commission given, only interest on loan to be 6%. We have already seen, and a profit sharing ratio will be equal. But since a profit, if it is allowed in the partnership deed, accordingly it will be provided, and also the firm earns profit during the year. So there are two criteria. One thing, that if there is a partnership deed, if the partnership deed allows, and there is profit in that particular time period, only then salary or commission will be paid. So there is one more thing, commission allowed. It is two, in the question there will be two type of statements given. One statement will be percentage of net profit before charging commission. Another statement will be percentage of net profit after charging commission. So if it is before charging commission, you need to apply this net profit before commission, whatever is a profit, because commission will be usually paid in the percentage form. So for net profit lerunda, how much is the percentage that the partner should get as a commission, we will calculate. So suppose, for example, if it is, he has to get 10%. If the net profit is 10,000, he has to get 10%. You will write 10 divided by 100. Okay, so this is what if it is given net profit before charging commission. Suppose if it is given net profit after charging commission, what you have to write? 10,000 is the net profit, 10% is the rate of commission, divided by 110 you have to write. Okay, so it is 100 plus the rate, so 110. So like this you have to make the calculation. So journal entry for this will be, you have on allowing salary and commission. What is on allowing salary and commission? Salary and commission is a expense. So expenses increases, so you are debiting it. And partners capital, see, salary, commission and all will boost up the capital. So capital also increases, so you are crediting it. Or partner, partner's capital account will increase. Okay, so that's why you are crediting it. And next one, on closure of the salaries commission account, on closure of salaries commission account, anything for that matter, if it is an appropriation account, you need to debit it to the P&L appropriation account. So P&L appropriation account debit to partners salary or commission account. So this is the journal entry for this. This is another recap of interest on partners loan. See, interest on partners loan is a charge against the profit. Either profit irko illiyo, you need to pay the interest on partners loan. But salary and commission, profit, if you have profits only, you can pay. Okay, so here interest on partners loan is a charge against the profit. Where partnership deed provides or not, it has to be given to the partners. So if deed is silent, interest percentage will be 6% per annum. And if the deed allows, suppose for example, if deed says interest on the partner's loan is 7% or 10%, accordingly it will apply. So 10%, there you should not say that 6%. Okay, so if the partnership deed says it is 10%, then it is 10%. So what is the interest? That is journal entry to provide interest on partner's loan. You have here interest on partner's loan account debit, because it is an expenses. Interest on partner's loan, it is an expenses to the firm. Am I right? So interest on partner's loan account debit to partner's loan account, liability increases, so you are crediting it. To close the interest on partner's loan, P&L account, because it is a charge against the profit, so you will not write P&L appropriation account, that is wrong. What you have to write is P&L account debit to interest on partner's loan account. So this have to be very clear. And one more important thing that we need to understand it clearly. It is important to distinguish loan and capital account of the partner, because Partner is different, lender is different. When partner is providing capital, he is acting as a owner. When partner is providing loan, he is acting as a lender, who is a creditor of the particular business. So as per Indian Partnership Act 1932, partner's loan is repayable on dissolution before payment of capital. So what you have to give priority here? He is acting like a third party. Here he is acting like a owner. So whatever amount that needs to be paid to the third party is get the first preference. So that's what partner's loan is repayable on dissolution before payment of capital, and in the absence of any agreement, partners are entitled to get interest at 6% per annum on loan, whereas they are not entitled to interest on capital. Okay, so this we are already aware of. So these things, please make sure that you learn it correctly. I'll see you in the next video class. Thank you.